I'm going to share with you a trading strategy that nobody talks about, and the reason why this works is because of futures. Okay, as you can see here, there's a forward slash in front of this ticker. That means it is a futures product, and futures uses something called span margin, and that's what's going to allow this strategy to be so powerful. So let's get straight into it. And what you want to do is pull up a watch list of futures that have options available to trade on them. Tasty Trade, the broker that I'm using, supplies this watch list natively. If your broker doesn't do that, copy these tickers, make your own custom watch list. And the important thing is to have IV rank on your watch list and order your watch list from high to low IV rank. And you're only interested in looking at things to trade that have an IV rank of at least 30. Okay. And what we're going to do is we're going to select an underlying. We're going to use natural gas. I think we're just going to use natural gas moving forwards for example purposes. It's a really good underlying with great premiums, and it's kind of in the middle range. If you have a smaller account, maybe you want to stick to things like soybeans, bonds, currencies. If you have a sort of small to medium account, natural gas will be fine. Anything above that, natural gas will be absolutely fine. So for most people, natural gas will be fine. If you have a smaller account, by all means, just pick a smaller, or not necessarily a smaller underlying, but a different underlying. So without further ado, natural gas we've selected. You want to then go over to where you can see a list of option expiration dates for that particular underlying, and you want to pick one that's between 30 and 60 days out. So we've got one here 40 days away, May 27th, that we're going to open up. And now we can see the options chain. So what we're going to do here, before we do anything actually, you want to make sure you have the delta columns for both your call and put side of the options chain. And what we're going to do is we're going to sell some really far out of the money contracts. Okay. Now, normally, if you were to do this with equities, let's just pull up Tesla so we can show you the difference. Okay. So we're just going to ignore the fact that it has earnings. So let's just pull up, 29 days away. And what we're going to do is we're going to sell a strangle. So one call and one put at around 5 deltas on either side. Okay, so 5 deltas on either side. There we go. And as you can see now, we're pretty much delta neutral. A very high pop, a very high P50. We're going to collect, but this is where things get crazy. So we're going to collect $279 in premium, and our buying power requirement is going to be $9,672. Okay, as you can see, this is a very small return on your capital, and that's because we are so far out of the money. We're hardly taking any risk. Our win rate is so high, our probability of profit is so high, and therefore our return on capital is so low. So with those numbers in mind, let's go back to natural gas, pull up May 27th again and do the exact same thing. 5 delta on the put side, 5 delta on the call side, like so. Exact same thing. And now let's look at the numbers. So our pop is still just as high, okay, 91%. Our P50 isn't displayed for futures, but for equities, as you just saw, it is. But your P50 is going to be in the same sort of range as what we saw for Tesla, so around 95%. And your P25 is going to be even higher than that. But the important thing that I want to show you here is, let's look at the profit numbers. So our max profit is $350. Okay, we're going to collect $350 up front, and our buying power requirement is going to be $1,000. So as you can see here, we're looking at about a 30 to 34%, technically here, 34% return. So that is far higher than what we just saw with Tesla, where you were collecting about the same amount of premium, but you are putting up 9 to 10 times more buying power to open the trade. And the reason why this works is because of futures, and futures uses span margin, and span margin is what allows us to get these great returns on capital with these high probabilities of success. Okay, and this is it. This is the position. You just want to do this as many times as you can, over and over again, as many occurrences as possible to eliminate short-term variance, although you are going to be winning almost every single time. Exit at 50%, exit at 25% if you want to, But basically, this is the structure. Okay, if you want to collect more premium, you absolutely can. You can just go further out a little bit if you want to. It's completely up to you. You can, play with the positions to make these numbers fit your risk parameters. Okay. Now there is one thing that is non-negotiable, and that's your buying power requirement. You have to keep this in check at all times, no exceptions. And the way you do that is by using our free position sizing template that we have created. The link for that is in the description. It's completely free. Everyone can get a copy. The way it works is you enter in the size of your portfolio. Say if it's $50,000, you can then enter in whatever the current VIX level is. It's not actually 32.1, but we can just pretend. And everything is going to be automatically calculated for you. It's going to tell you exactly how you need to structure your portfolio. As you can see here, it's going to tell you what the maximum amount of buying power is that you should be allocating to your different position types, whether it be undefined risk or defined risk. What we looked at here is an example of undefined risk. As you can see in this example portfolio, you can allocate up to $3,500 per position and in buying power, and we're only going to be using 1,000 here. So this position would be absolutely fine to put on in this example portfolio. As long as you're sticking to this, you'll be absolutely fine. Now, if you would like to learn in more detail about what we do and how we do it, click on EDS Premium. The link for that will also be in the description. Get yourself signed up. Once you are inside, you will have access to this exact portfolio that I'm showing you here live. This is a real portfolio. We do have a position on right now. We're currently 18% in profit on this position. This is our fourth position for the week. We've just been doing some 0 day to expiration stuff. 3 positions we've opened and closed so far this week. All 3 have been winners. This fourth one is looking to close as a winner as well. So we're looking at closing in on a 100% win rate this week. And you'll have full access to that portfolio. So you can reverse engineer our trades, study them, copy us. It's completely up to you. There's also a full course as well. So no prior knowledge is required. We will teach you everything that you need to know from start to finish. And it's a private community. So if you get stuck, you can speak with myself, you can speak with other members that are already inside, and there's also a 100% money back guarantee. So once you have been through the full course, follow some of our trades. If after 6 months you are not profitable, we will work with you for free until you are, or you can request a full refund. So it is completely risk-free. It's $9.99 a month to join right now. The price will be increasing once this current wave of members is full. But once you're in, the price is locked in for you for life. So you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. Once you've learned what to do and how to do it, you could take that with you forever. No one can ever take that away from you. It's a very powerful thing to know. And we aim to get you to a point of where you are self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.